My name is Brian Overby, and welcome to Options Guy TV. I'll be your host here for about the next 25 minutes on Options Guy TV. Today's date is Monday, April 22nd. The markets are open and rocking and rolling, and we have a massive week ahead of us. Right now, the S&P 500 index is trying to figure out where it wants to go. I think that's the best way to say it. We broke below the 5,000 level. We're trading right now at 49.75. I think a lot has been centered around the wishy-washiness of the Fed and the strong economic data. We basically had CPI and inflation was laying on the ground, and they bounced back up and did the standing 8 count. And now the inflation is a real thing. And the data is basically telling the Fed that they should not lower interest rates. But we're also keeping high interest rates for longer can do some increased damage too. So the Fed really wants to cut rates, but the marketplace won't let them. And the markets in general are really struggling with that concept. Now, a great example of that is IWM. We talked about the potential to get long IWM, and we waited actually. We did it on a Friday that we mentioned where IWM was at on the chart. And we said, well, let's wait and see what happens next week. We have some data that was coming out. And then all of a sudden, the data was not good. It was good as far as the economy is concerned, but as far as the Fed and the markets are concerned, they did not like how good the economy was doing, not to mention the fact that CPI is starting to go in the wrong direction once again, inflation in general. So that really hurt the Russell 2000 index. And basically that index was riding with banking on the fact that the Fed was going to cut rates most likely in June. And that doesn't look like that's going to happen now. Going out to July, there's still a decent probability, but that is waning. Every week that goes by right now, the probability of them doing a rate cut this year is going down. And at the beginning of the year, we're talking about 5 or 6 different potential rate cuts. But at this point in time, it doesn't look like it's going to happen. So I'm going to start by looking at the chart in IWM. So let's run to the TradeHawk software. And once again, a very interesting chart. This is going back 1,000 days. We have the 50-day moving average and the 20-day moving average. It broke through both of those. Now we're coming down to a different level of support right in this range. And I'm going to follow my cursor across 192, let's call it 192. And this was a gap that we talked about it filling. And this is also still a gap up. Our cursor is right here, but there's still kind of a small channel, a small area of resistance and support, depending on which way the market was going at that point in time, right around this area. So if we do break below that today, the path of least resistance is down to the 200-day moving average. So the market is still really sketchy in IWM. And let me zoom in on this. I'm going to grab from right about here, and I'm going to zoom to this corner. And obviously, this is the beginning of that big solid up candle right here and the beginning of the move when we kind of flip-flopped on IWM, literally a complete 100% flip-flop. And we were trading right around right here when the Fed was still thinking about, I should say it was probably right in this range, when the Fed was still thinking about cutting interest rates, and that was the path of least resistance was lower interest rates. Then all of a sudden it was not apparent anymore that the Fed was going to cut. And we talked about filling this gap, and that happened. So we were right here, right at the bottom of this candle, and about the potential to fill this gap right here. And now we're trying to fill this long candle, this huge gap up all the way down to the 200-day moving average. So I think the path of least resistance right now, to use that phrase way too many times, is to the downside in IWM. But I'm looking to do a trade somewhere within that range. So if we go back, if we obviously break down within this range, and the Fed and the probabilities of the rate cut continue to go down, and we break underneath this 200-day moving average, I think you're definitely going to trade within this range between the 200-day moving average and to the bottom end of this channel. So if anything, if we do have that happen, I wouldn't mind doing maybe a long straddle. Marketplace has a little bit of volatility. The VIX is nervous. The VIX is still trading right around that 16 level, the volatility index on the S&P 500 index. So that index is really showing a lot of nervousness in the marketplace. When the market was actually struggling to get higher, the VIX was trading down around the 15 and 14 level. And in my mind, this was prior to September and October of last year. Even though we had a lot of volatility in the marketplace, we went into November and had a very strong November, and that sparked the rally. But during those times, we really weren't seeing the nervousness that the VIX is showing right now. And I think the fact that inflation is being a lot tougher to tame than anticipated has really made some of the nervousness in the marketplace through the summer months just come to fruition. The VIX is a 30-day moving average, and that's the volatility in the S&P 500 index on the 30-day weighted moving average basis. Okay, so a lot can happen this week. We have a lot of the mega cap tech stocks that are going to be announcing earnings. Specifically on Wednesday, we have Meta, and we will look at a trade in Meta, mainly because the show tapes at 11 a.m. Eastern time, and Meta is going to be announcing after the close. And then, oddly enough, I can't remember out of all my years of option trading that Amazon is going to announce on a Tuesday instead of a Thursday. This Thursday, we have a lot. We have Alphabet, i.e. Google. We have Microsoft. Caterpillar, which is in our paper trading portfolio, is going to announce on the open. We also have Intel. Meta is going to be Wednesday, and normally Amazon would usually be announcing on this Thursday. But for some reason, they're going to announce on a Tuesday. Very odd. I'm not really sure because they've always announced on Thursday. But with that mentioned, we will look at Meta. We'll also probably look at a trade in Alphabet, like where Alphabet is situated at this point in time. All the concerns about the AI seem to have waned a little bit when Apple came in and did a deal with Alphabet regarding their AI tools and the iPhone. Once that news came out, people became a little bit more settled in with maybe Google is not going or falling behind as much as first thought in the AI space, and the stock has done well. The market in general hasn't done well, but Google ran all the way up to the 160 level before it actually slowed off. I was actually struggling with a lot of a call position, fig leaf position that we had in the paper trading account in Google, where we wanted to try to prevent the assignment, and just kept rolling all the way out. Now I'm all the way out to the end of May. At least the market has came down a little bit, and so we'll see what happens. But I don't like to be short an option contract, even though it's a covered position in Google going into earnings. But we'll look at a trade for Meta and Google at the end of the week. Paper trades, speculative trades, positions where we're going to learn a lot about pricing, and they're fun to do advanced strategies on short-term options with volatility in them. Something happens, right? With Google announcing or Alphabet announcing on a Thursday, The option contracts on Friday have 1 day to live, and that's it. And so a lot happens quickly in those option contracts. All right. So now today we're going to stick with our rinse and repeat strategy in the S&P 500 index. Still feeling like it's going to be really tough for the markets to go higher. Or even though we have a ton of earnings, it's going to be really hard. We've seen Nvidia sell off. All the frothy stocks are getting a little bit of a sell off here recently. So I'm going to keep with the theme that we are neutral to bearish on the marketplace. We've been doing a lot of skip strike butterflies way out of the money in the S&P 500 index. That strategy has done very well. It's done very well since we started Options Guy TV. Every week that we've decided to do that trade, we haven't really even had. I'm trying to think. I don't think we've ever had one that actually we got very close on an expiration where it kind of moved against us on the day of that expiration. I remember that trade, but in general, this has been a very solid trade here on Options Guy TV. And if you have any questions and you are in the Tradier YouTube platform, you can put them in the chat box and I'll try to address them during the show. We want to make this as interactive as possible here on Options Guy TV. So let's go back to the trading page, and I have the S&P 500 index trade all set up. Oh, it moved against me a little bit. Was a 70-cent net credit, and I really liked it at that level. I think I'm going to want to adjust it at this point in time. But here we are. We're going to look at a skip strike butterfly in and let's pull up the options playbook. Why not, right? I wrote it. Why not pull it up and show the skip strike butterfly? So I'm going to swap out. So let's jump back out here a little bit. Go to full screen for a second. And I am going to pull up the good old skip strike butterfly. 1 second here. And we will discuss that trade because we've been doing it quite a bit. So we're going to discuss it a little bit. I'll show you the quick profit and loss graph, and then I'll show you the setup here, mainly because we have time today. I'm not going to do an earnings trade. There's nothing that is that interesting tonight that I really want to set up an earnings trade on. So let's take the time to go and look at the skip strike butterfly. So 1 second here. Just need to swap out my browser. And there we have it. Options playbook. Let's do it. All right. So lean back this way. Here we go. Skip strike butterfly. So here's what we're looking to do. We're going to go at about 1 standard deviation from where the S&P 500 index is at. We're going to use the Friday expiration option contracts. We're going to be skipping strike C. A standard butterfly would be buy strike, and let's hit the setup here, would be buy strike A, sell to a strike B, buy strike C. We're going to skip that, and we're going to go to strike D. So in this situation, by skipping that, we're embedding a short call spread, selling strike A and buying strike D. We're going to be embedding that, and we're going to use that to pay for the butterfly, for the standard butterfly. Now, I want to emphasize once again that I look at this as an alternative to a short call spread as opposed to an alternative to a standard butterfly. And if what we're doing is selling that credit spread to help pay for the butterfly. So if I'm selling a short call spread, I'm neutral to bearish on the market. I don't really want the market to go up. I'll be okay if it does, but I'd rather have the market stay where it's at or go lower over the week and get some massive time decay in the S&P 500 index option contracts. By doing the skip strike butterfly, we don't bring in as much of a credit, but we have our hedge in. If the market stays where it's at or goes down, we can make the net credit, no problem. If the market starts going up, though, as long as it takes a while to go up and we get close to that expiration date on Friday and we land somewhere between strike A and strike B, that's a good thing. And we can not only bring in the net credit, we could actually close out or unwind the butterfly for a net credit. So you're getting into the trade at a net credit and you're getting out of the trade at a net credit. That is possible with the skip strike butterfly. but it only happens on that Friday of expiration in the S&P 500 index options. If not, to start with, you want the market to stay where it's at or go lower if you're just trying to make the net credit on the position. So now that we see the inside the options playbook, let's jump back out one last time here. And we'll run to the TradeHawk software, and I'll show it actually in the what if calculator, but let's set up the trade just like we had it. So here's our S&P 500 index chains, and 49.69 is where the market is at. One standard deviation, we're at a 60-cent net credit. I'm going to move it. I didn't mind that, but I want to move it now. We're going to go down to the 570. I want to get a 70-cent net credit. So if we buy this one, we sell two of these with the VIX trading, like I mentioned, right around 18%. Buy, skip the 50.90, buy the 5100. 1 buy, 2 buy 1. Still at a 60-cent net credit. Really thought 65. We'll call it, well, let's call this 65.65. That's what I would work at. And if I can't get, I want to get 65 to 70 cents on this trade. And if I can't, I would even move down to the 50.65 because I want to bring in a decent credit to make this worth my while. 1 second here. Okay. So there it is. There we are. I saw the 70. So we're going to keep it right at 65 cents. I'm going to send this to the what if calculator. And note the expiration date. 4/26 is the expiration that we have, which is this Friday. And let's zoom in. Here's where the market is at. We'll grab it from right there and we'll zoom in a little bit on this. And let's zoom in one more time. So here's where the market's at. So once we put on this trade, here's how it works. Based off of this date and this time, using real market data, using implied volatilities from where the market is at right now. If you put this trade on and the market went against you to start with today and ran all the way up to your long strike, your 50-70 strike call option right here, you're going to be down on that position. And if you look over on the y-axis, you see you'd be down about $300 on this butterfly trade. Now, the maximum you can lose is the width between strike C and strike D, which is the skipped strike. And the maximum you can lose is about $1,000, 10 points. And that's if the market goes well beyond the 1 standard deviation move all the way up to the 5,100 level. That's where our risk kicks in. So our risk kicks in from about where that strike that we skipped is all the way down to here. Anywhere within the wings of the butterfly, we're going to be okay. But here's how the time decay works, just to show you. And this is fairly accurate. The S&P 500 index is a very liquid underlying. So the theoretical really works fairly well. It's obviously going to assume the implied volatility doesn't change. But if we start right here and we are on the 22nd, let's go to Wednesday, and you won't see a ton of change by Wednesday. Now we are profitable anywhere within this range, but now we're starting to get hurt a little bit. Now remember, we did this for a net credit of 70 cents. So anywhere down here, if these options expire worthless at all, if the stock's anywhere within this range, the net credit of 70 cents is yours, right? The options would expire worthless on Friday at the close, and you would have that net credit in your account. Now, you go from Wednesday to Thursday, and the graph gets a lot nicer, right? Now we got a huge range where we're doing okay, getting a little bit tighter in this range, and now let's go from Thursday to Friday. Now we're profitable within this range. Now, I'm emphasizing that this is at 11 o'clock. This is as of this taping. So if we change this up and you go to let's go to 14. I think that's the time, the way that I want to do that. Now all of a sudden you see that we are approaching that level. So now we can even bump it up. Let's go to 15. Watch how much it moves now, even with 1 hour of time change. Now it's really starting to pay out inside the range of the butterfly. So as the market approaches from 11 o'clock on, There's a huge rate of time decay that happens. Bottom line is if I put this trade on and it ran up, boom, to our short strike right now, I just want to get out. I don't want to have this risk. I don't want to get in this range where it could really, really hurt me. So if it hits right away, then I'm just going to get out of the trade, much the way that I would if I was short a call spread. If it starts drifting this way, well, I don't mind on Friday if we start out somewhere right around here and drift north. Well, then I might trade that during that day. But my goal right now is to try to make that net credit of 70 cents to the account. And you can do it on a different, if you want to bring in more than a 7, there it is right there. That's where it should be too. I just, all these, I've done this trade so often that once you're right around, see, this is a 15 delta. When you're buying that 15 delta or 16 delta and you're going 10 points wide, it's normally a 70-cent net credit. That's just usually where my goal is at. Obviously, the VIX affects that. If the VIX was down around 12, it would be hard to get that type of credit around that 1 standard deviation move. All right. So this will be the paper trade for the week. And I see we are coming to the end here. If you have any questions, put them in right now in the chat box. I'll chat on for a little bit because there's usually a little bit of a lag. And if not, please click subscribe if you're on the Tradier YouTube platform and ring the bell. And we'll see you this Wednesday. We're going to look at a trade in Meta and probably a trade in Google, going into the Friday close and the Friday expiration of the option contracts that we will be trading. And then we'll look at our paper trade in the S&P 500 index, the standard trade that we usually do something every week in the S&P 500 index. And if we have to make any adjustments on Wednesday, we will do so. Thanks for coming. I don't see any questions, and we'll see you this Wednesday for the next edition of Options Guide TV. Thanks for stopping by.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.